On September 13th and September 14th, Blockworks is hosting its Digital Asset Summit in New York yet again. I will be hosting a macro conversation with Alfonso Peccatiello, Urian Timmer, Daniel DiMartino Booth, and Mike Green. That is just one of many conversations at DAS. Think the deals end there? No. Blockworks Research is the premier institutional crypto research product. And if you use the code GUIDANCE, all lowercase, you can get 50% off on Blockworks Research. Our head of research just wrote a second quarter macro review of all that happened over the past few months. It is free. So if you click the link in the description, you can get that for free. And then use the code GUIDANCE, all lower caps, to get 50% off Blockworks Research. Thank you. Or should I say, you're welcome. I am joined by Tian Yang, CEO and head of research at Variant Perception. Tian, welcome to Forward Guidance.
Thanks for having me. I've been a long-time fan of the show, so glad to be on.
Thank you, Tian. The pleasure is all mine. I know you, and perhaps a lot of people know you, as one of the very early proponents of the commodity supercycle thesis. And you were talking about the commodity supercycle when most of the world was focused on the potential of a great global depression, in the spring and summer of 2020. Explain your thinking, why you're in the commodity supercycle. Obviously that has played out to be right. And what is your current outlook? Do you think the supercycle has more legs to it, or is it going to encounter some headwinds given that the economy is slowing, global economy is slowing?
Yeah, sure. So really, I think the way we try and do investing and the way we do research here is we're very particular about time horizons. So we've built a number of different kind of models and trading systems and business cycle tools. And what we realize over time is that a lot of times you'll get very conflicting messages. Your tactical system might be bullish, the business cycle might be turning down, but your structural models might be saying, commodities are super capital scarce. So I think what we try and do is we're very explicit in focusing on these time horizons. And when you get all of them aligned is when you kind of have really these, huge, big trend investment opportunities that probably come along once every 5 years, say, and then you kind of have to just ride it the whole way up. So essentially what we had back in 2020 was that your kind of 3-year plus structural models where we track capital scarcity across 400 different global region industries. We're just flagging everything related to commodities as being super under-owned, super, capital scarce. The asset base was shrinking. No money had gone into it for ages. Which, by the way, was the same setup as in 19 as 20. But the difference was coming out of COVID, you had obviously the huge kind of cyclical policy stimulus. You had the China lead indicators turn up. You had liquidity absolutely bursting, to all-time highs, like unseen kind of acceleration. So when you match up those kind of cyclical and structural pictures, that's when you're like, okay, this is probably going to be a major trade. And then obviously you get a lot of your tactical models showing people are super bearish, and then the trend starts turning, and then obviously it's kind of away. So that was kind of what led us to the theme originally. Now, obviously, if you fast forward to today, I still think broadly speaking, that kind of 3-year plus setup is still valid. Obviously, it's probably more concentrated in some of the areas we identified back then. So energy, copper, some of these areas are still pretty capital scarce, I would say, with a lot of upside. Fertilizer, food, ChemAg, all these things are still very capital scarce. But the main difference today is the business cycle, right? The 1 year, the 6 months, the 1 year plus indicators, those kind of cycles, they've obviously turned completely the other way. Obviously, there's been a lot of talk about recession risk. Obviously, the Fed's still in hiking mode. So I think the challenge today is you've got basically still a very good structural setup, but extremely bearish business cycle indicators, and they have been for basically the whole of this year. And so in that environment, it's not necessarily like a full, you want to bet the farm kind of environment. So we've kind of termed it as a commodities supercycle intermission. Again, timing was pretty good because we kind of put it out in May. But the basic idea is that you've seen this before in kind of even the mid-2000s supercycle, where you just trade sideways net for, say, 3 to 6 months, but it's extremely volatile. So, it's probably an environment where gamma realizes quite well because of the headline risk and so forth. But broadly speaking, you don't want to be taking too much risk. You kind of just want to let it play out, let the business cycle naturally bottom. So obviously today that will kind of mean Fed hikes us into recession. We get the recession, inflation comes up, business cycle turns around. And at that point, okay, look at where do you want to go in commodity land? That's probably more why I'm thinking about it. If you have a 5-year plus horizon, for sure you want to maintain your kind of strategic commodity allocations, especially given all the tail risks around food inflation energy, inflation, and so forth, right? In terms of damage that can do to the rest of your portfolio. But if you're talking kind of 6 months to 1 year, which I think whether investors like to admit it or not, a lot of times that's our kind of horizon, I would say then you probably don't want to be, have too much risk on right now.
And how confident are you in the business cycle slowing down being a drag on commodities? Like, let's say all you cared about was the next 3 to 6 months. Would you be long or short commodities?
I think 1 month plus, 1 to 3 months, I think our bias would be trading wise to play for a squeeze a little bit, just because this recession narrative could still play out for a little bit. But I would say, next 6 months, I'm generally tilting everything risk off, right? So commodities, naturally, the bias will probably be slightly risk off. Now, from the business cycle point of view, I would say some of the best lead indicators VP has built, and that's really served us well over kind of the 12, 13-year history of the firm, is really liquidity lead indicators, typically giving a 6 to 12 month lead. So, they were turning down a lot back in the fourth quarter of 2021, right? And they've been deteriorating throughout this year. And so the problem today is they're not turning up. They're getting worse, right? It's kind of like, it's pretty shocking to us. Every week we update the model and like it's say a 30-year lows and it just makes a new low. Like just when you think you can't get any worse, it just keeps going lower. So I think it's in that kind of environment, it's very hard to have too constructive a kind of 3 to 6 month outlook, even if we love the structural picture. So actually, broadly speaking, if it's a risk-off environment, I'd be more tilted towards kind of like, long duration, right? Long cash still, kind of wait it out. Don't be a hero, kind of as we speak right now.
Long duration, so long-term bond, even though you think inflation will plateau for the rest of the year, which is well above expectations.
Yeah, so I think equities and bonds are going to react differently to inflation this time around. In general, the impact from inflation on equities in our mind works in terms of excess liquidity, right? So our whole framework for thinking about liquidity is this idea that money is created from thin air by both central banks and commercial banks. And then when that money is created, it either goes in the real economy or it flows into asset prices. So today, because inflation is so high, it's eaten up most of the excess liquidity that's been created. So there's not much left over to support asset prices. So equities, risk assets are basically going to be a lot more vulnerable because you just don't have that floor of liquidity that usually supports valuations. However, on the bond market side, clearly it's going to be more linked, I think, ultimately to policy. And also it's going to be anchored on basically long-term stock bond ratio allocations, right? So I think one of the really big challenges with looking at fixed income from a structural long-term point of view is very, very hard to get a good fair value, right? Because typically the most models are like, okay, what is nominal? Essentially, what's like potential GDP? What's inflation? We add it up, right? And then you get this, theoretic fair value model, but you trade all around it. I think a more reliable way we found is to go back to first principles and just use something that's an accounting identity rather than just like a theory. So the key accounting identity is if we can track the total market cap of stocks and bonds in the entire asset universe, then that ratio is by definition what the average investor has to hold in terms of their stock bond allocations. Right. So that's what we anchor around. And our assumption is that ratio does not shift too much. That tends to be, fairly stable over time. And then by anchoring around that, obviously it gives us a bit more comfort. Actually, unless something goes crazy and the Fed completely loses credibility, those kind of things, yeah, people are going to need to hold on to their bonds, right? Especially if we don't get as much issuance as needed. So, and especially if you consider the issuance isn't at the long end, then you don't have enough duration in the market. So I think we're a bit more comfortable with the idea that in the long term, 10 years at 2.5 or even going down to 2 is not unreasonable despite where inflation is. And obviously we can get a lot of comfort by looking at all the money market pricing or the forward curves, right? If you look at the inflation swap term structure, again, 1 year, 1 year, 2 year, 1 year, it's all pretty well behaved, downward sloping. Look at five year kind of real overnight rates, right? They're all coming off. So again, for the most part, the fixed income markets are kind of telling you, yes, we priced the inflation tails. There's a lot priced in already, but the growth story is really going to take over going forward. So obviously that's naturally gives you a bit more benefit for bonds. I think bonds are kind of discounted enough in terms of how they should behave. So there's going to be a good chance for bonds to rally. For equities, ultimately it's contingent on excess liquidity, which is almost another way of saying Fed put. And obviously we're not going to get that for the rest of this year.
Okay, so you're not oriented towards stocks. Kind of, you expect a risk-off sentiment to last for the rest of this year because stocks depend upon liquidity, and liquidity is just not there, and in fact, it's falling. But you do think that duration, i.e., long-term bonds, will perform well because economic growth is slowing. But I want to get into this inflation point because aren't you somewhat like, what do you think inflation will print for the rest of the year? A lot of people I speak to who are long duration or like long-term bonds, they think inflation will rapidly fall. But it's my sense that you are not in that camp, right?
So, well, I mean, so there's something we can anchor around, right? Let's say we take the underlying core CPI and the CPI indices and just assume it's just flat lines for the entire second half, right? And then you can generate a year-on-year number for December, right? So on those numbers, headline CPI is still going to print 5% plus, and core CPI is still going to print essentially 3.5%, right? So even if like the indices start going sideways, the number's still going to be high, right? But obviously, in terms of second derivative, these things are coming off.
Yes.
I do have some concerns that ultimately, because the Fed's so far behind the curve and everyone's made such a big deal about like waiting for the data, right?
What is your longer term outlook on inflation? Because if you're Mr. Commodity Supercycle, commodities are key inputs to the prices in the economy. I figure if you're Mr. Supercycle, you should be Mr. Inflationista, but maybe you're not.
Yeah, well, so I think the challenge, and this is obviously a difficulty in our jobs, right? Where a lot of times you're supposed to give like a very declarative answer. This is how things will play out for the next 5 years. I think the reality is that the future is clearly uncertain and is very path dependent. So the way I think a lot about these longer term questions is I prefer to like see, okay, what are historical examples and what are signposts and roadmaps to suggest how things are going to play out. So what you can observe today is that obviously a lot of deflationary forces that was important in the past kind of 10, 15 years have gone into reverse, right? Starting with, China originally joining WTO, China's previous 5-year plans, which is just about purely flooding the market with cheap everything, even at the expense of kind of Chinese environment and the expense of Chinese living standards almost, right? So like clearly that's kind of a big shift. Obviously, COVID has caused a big shift in terms of supply chains where we're moving away from just-in-time supply chains. Everyone's going to hold more inventory, especially if you anticipate inflation, you'll naturally hold more inventory. So, from a supply side point of view, things become less efficient, so there's more inflation. So there's like the ingredients needed to get the initial kind of jump up in inflation. But obviously from here, I think the key to whether we go to this kind of 1970s or extended period of inflation is ultimately whether you get the wage price spirals getting hold and what happens to inflation expectations, right? So this is where like the signposts that we need to see are things like how is union activity? Obviously we see it starting to pick up. What kind of bargaining agreements are coming out? Is it CPI? Is it CPI plus? Right? Because obviously, in the developed world, we might not be used to this, but this happens in emerging markets like all the time, right? Even in the past 10 years, you go to Argentina, these places, right? The reason it's so hard to get control is because everybody stops believing the CPI and then everyone gathers together. So then the unions say, okay, CPI is a 20. I don't believe your number, so I want 20 plus 10 for my wage bargaining, right? And obviously, you're starting to see the very, very early stages of that in terms of in the West, right? And obviously, I live in the UK. We're kind of seeing constant strikes now, between like the tube workers, the train workers, right? Obviously, you see the news around Amazon unionization. So I think these are like some of the signposts you kind of need to initially see, and then you can see how the path dependence goes, whether there is more unionization, whether you do get more of those kind of mechanisms in place to really keep inflation elevated. So that's why I would say, as of right now, all we can say is yes, a lot of the factors have reversed. It is going to bias things higher. It's potentially going to cause a path dependence where if companies believe that we're moving to a more inflationary environment, naturally the right response is to hold more inventory. That in turn obviously contributes to more inflation down the line. Other things that are very interesting historically, if you look at these periods of inflation, is you actually get a lot more vertical integration, because obviously you want to basically, if you can just vertically integrate your whole company, you can strip out a lot of the profit margins in the middle, and then hopefully then as an aggregate, you can still maintain a good profit margin, right? So again, we're not quite seeing that because the liquidity environment's poor, but maybe as it comes back, that's something people think about. So that's why I wouldn't say it's so obviously it's one or the other. But clearly the risk is biased more to the upside because, very important factors like China have reversed, right? Clearly the Iron Curtain's descended. Pelosi is going to go to Taiwan, as we speak, right? So there isn't going to be the cooperation. So clearly a lot of these things are shifting, but whether you truly go back to kind of the loss of control you see in the 70s, I think it's I don't want to sit here and just say yes or no, right? I'm just watching for it. I think it is a risk going up, but the signs you normally see aren't quite in place, right? Labor unionization is by far the most important, and you should also see it in corporate behavior. And until those two things happen, you probably don't have the mechanisms to really engender kind of sustained high inflation. In terms of tail risk, by the way, you mentioned food and energy. So I do think that, again, the tail risk is somewhat skewed to the upside because, we mentioned the kind of capital scarcity issues around energy, food. I think Peter Zeihan has been, making the rounds a lot recently on a lot of his thesis, which I think has a lot of validity as well in terms of path dependence. So there's clearly a lot of tail risk there as well. So I think the reality is you probably don't want to bet the farm, but you kind of want to have tail risk exposure to kind of inflation upside because clearly that's going to destroy the rest of your portfolio. But it's probably like say like a 2080 or 3070 scenario, right? You still probably ultimately want to bet that the liquidity cycle is going to drive asset returns going forwards. So you can't just fully go on the inflation train. But are there asymmetric kind of payoffs, say like in kind of in ChemAg or in these fertilizer prices or in food prices, where if something bad really happens, it is going to be like an order of magnitude move. That's probably more how I would frame it. Like there's been so much talk about letting the data roll over and the data's lagging. That's why I think the Fed's kind of somewhat locked themselves into what they can do. So going forward, the July, August, September month-on-month changes in 2021 was actually very low. So your base effects actually become quite hard. Right? It's going to bias up the year on year. So even the best scenario where it just flatlines, you're still going to end up at 5, right? So certainly we're not going back to 2. There's no chance of us going back to 2 this year. But from a bond market point of view, I think what the market's been trying to price is just the derivative and the peak, right? And so the behavior of the market in terms of what all the different money market inversions you're supposed to see, right? The Euro-dollar curve inversion, how kind of like 2-year versus 5-year. There's a lot of these money market relationships that normally you see once you price in peak hawkishness in monetary policy. That again you see pretty much across the board right now. So that's why I have a lot more comfort that the kind of bond market moves make sense. And again, in terms of the historical move, it does make sense, right? You're supposed to get curve flattening going into kind of a recession, right, and a curve inversion. And then once the pain gets too much, the Fed basically has a shift in policy and then the yield curve steepen. So again, like in terms of that playbook we're following, it kind of broadly still makes sense. So yeah, I would. That's why I characterize it. I think it's going to be different. If we're truly going back to 2%, arguably it's good for equities as well, right? So I think we're just in that tricky spot where the second derivative gives a chance for bonds to have a pretty decent counter trend move for a good few months at least. Whereas on the equities front, there isn't much there. If we go back to tactically, one of the best trading models we've had this year is the LPPL trading model, which basically predicted the bond crash and predicted the end of it in June, right? So obviously since June, we kind of, that's kind of told us that initial crash, the initial surge of selling is over. So that's why it also makes me think like the bias now is with all the inversions, our fair value models for 10-year yields are collapsing. The trading dynamics suggest all the selling is over. So when you put it all together, it kind of says, maybe not everything's fully aligned, but most things are aligned to just be like, this is the environment where duration should perform.
What does LPPL stand for? And can you tell us a little bit about the thinking behind the model?
Sure. So it stands for log periodic power law. We didn't invent this, right? The original, I think it's been around in academia for quite a while. We got familiar with it originally through the work of Didier Sonnet, who was like a professor of geology originally when he was studying earthquakes. And he essentially realized the dynamics in which an earthquake takes place, where you get, some tremors that potentially lead to like a, magnitude 9 earthquakes, but like some tremors don't. There's a specific pattern of behavior you observe that leads to these big earthquakes, what he calls regime changes, right? And so essentially he started applying this to financial markets. And so he started training his models on like the 1987 crash. And these kind of examples, he realized it was such a good fit for how financial markets crash, both on the upside and downside. And so it's really, his original idea. And the idea is essentially this is like social dynamics, right? Where you have, different actions affect other actions and then what particular pattern leads to stampede. So, at a very high level, that's kind of where we got the idea from, and essentially looking for fits and trying to find good fits for this kind of log periodic power law pattern in price behavior, flagging those. And typically that will be a good predictor of when you're into kind of a crash regime and when the regime ends.
Okay, so before the S&P crashes 20%, it has to crash 2% first. There's a tremor before a big fall. Yeah.
Yes. So it's almost like specifically there's a particular pattern that has a predictive power statistically that's more likely to predict a future crash versus like a normal like outcome, right? So, for example, this year on January 11th, all our models for tech just went crazy. It was like rarely, because by the way, LPPLs are very rare. They shouldn't happen that often. So I remember in January, and obviously we put it out in the reports and stuff. Yeah, like you had like the ARK ETF, the GS on profitable tech, Zoom, all of these were like an LPPL pattern. It was like predicting at least 30% down at that point. So, I think it's a pretty interesting model that if you have a business cycle overlay and a liquidity overlay, it gives you a bit more confidence to take the signal and structure trades around it. Because obviously, like ultimately the liquidity cycle is still going to drive things. But if you're in a bad liquidity environment, it says to go short, then obviously you have more confidence. Equally, we had an upside LPPL prediction for energy. So it was predicting a blow off topping energy in April. And all energy obviously did massively outperform from April to June before it kind of crashed a bit. But clearly it got nowhere near the levels the LPPL predicted just because the liquidity environment is so good, right? So there's still some context I think needed, but it's a pretty, I think it's a pretty interesting kind of newer thing that's come into finance in recent years that, that at least we found when we actually try to implement it is pretty useful.
Right. So you said that liquidity, Tian, you said that liquidity drives asset markets and people can bet on that in the future. Over the past decade, that has been a very good bet as central banks have eased monetary policy largely in a synchronized fashion. That was very good for asset prices. What about now, though? Because a lot of people, as you say, they're banking on a Fed pivot. The Eurodollar curve, Fed funds, the interest rate market is betting that the interest rates will peak in December or January. And then after that, on the probabilistic basis, the Federal Reserve will start cutting. What do you think about that? And are we in a different, is the playbook over the past 10 years where anytime you have a business cycle slowdown, the Federal Reserve is there to have the back of investors? Is that are we in a new paradigm?
I think we are in a new paradigm, right? I think there's a reason, you've had, bonds and equities crashing this year and all the buy the dips haven't worked. It's precisely because everyone's used the past 10 years where the Fed put kicks in quickly because the Eurodollar curve, as you say, instantly responds to S&P sell-off. But the Fed's told you already this year, inflation's a big deal. So that mechanism isn't there to get the Fed pricing to shift quickly, right? So for sure, we're already living a new paradigm. Now, to me, a lot of the market pricing is probably more important for trading fixed income and also to give you more an idea of the second derivative and the impulse of liquidity behavior. How we measure liquidity is actually more from first principles. We have we actually try and measure the quantity of it. And those are things where they're not super responsive to just immediate shift in Fed policy, right? Like I said a bit earlier, liquidity is not just from the central bank. You kind of need it to happen in the real economy. You need commercial banks to be willing to lend. You need lending standards to be loose enough. You need that to be loan demand. So, that's why for us, the way we define liquidity is really this idea of global GDP-weighted real narrow money growth minus economic growth, right? That's what we call activity.
What does narrow mean? Narrow money as opposed to broad money? Yeah. What does that mean?
So narrow money, essentially M1 are equivalent, but the problem is M1 is defined differently. So you should essentially think of it as demand deposit plus currencies for all economic sectors, right? So I think the Conference Board has done some studies, right, where historically they had M2 as a lead indicator, and then over time they realized it doesn't work because obviously savings deposits doesn't necessarily go up and means more future activity, right? Sometimes people save more because they're worried about the future.
Tian, so I have a partial understanding of M2. Let me just explain what I know, and then you could come in and add more details and nuance. So M2, a monetary aggregate, is kind of the vanilla version of money supply that is bandied about. And if you've seen a chart, if folks watching this have seen a chart of the money supply is up 40% year over year, or it's down 20% year over year, it's probably M2. And it's an accurate statistic, but it's the problem is that it is extremely sensitive to quantitative easing. So if the Fed buys a bond from JP Morgan, and then I'm a customer of JP Morgan. JP Morgan will then buy the bond from me, and then on my bank balance sheet, I have instead of a treasury, I have a savings deposit or a checking account or something like that. And the problem is that that I have the same amount of money. It's just instead of a treasury, I have a bank account. So it's that's the problem that I perceive it. Tian, what am I missing there? And then also, in what ways does M2 differ from M1?
Yeah, sure. So I think if you talk about longer term trends, M2 is pretty good to give you a sense of the big trends. But if you're using it for timing, I think the issue is it's not leading. It tends to be coincident with what's going on. So the main difference from M1 to M2 is M2 captures more savings deposits, so i.e. more locked up money that isn't actually doing as much. So usually when we park money from our checking account to savings accounts, it's not necessarily always for a bullish or good reason, right? It could be I'm more worried about the future now, or I don't want to deploy my cash into anything else. I'm just going to lock it here in the safest form of money. So a lot of times the changes in the savings deposit could actually be a bad sign rather than a sign of optimism. And in fact, when you look at the conference board and some of the studies they've done, they've flagged this as well. So they've even changed their definition of where M2 is no longer considered a lead indicator. So in general, M1 is better because it's essentially currency and demand deposit. So basically, when that is really high, people are either going to park into M2, right? Are you parking in savings because they're suddenly not so optimistic about the future, or it's a sign that there's a lot of activity going on and there's more to come. So usually we found M1 tends to be a more reliable lead indicator. The definition of it is a bit different by country, but so you need to do some adjustment. But essentially, you just want to capture demand deposit and currency for all the sectors of the economy and lump that together. That's what we kind of consider high power money. Obviously, the behavior a lot of times is going to be similar in that it's still responsive to QE. But in our mind, it's just a bit more leading, actually. You get a bit more of a sense timing from it as an input into the models.
How would you say, how rapidly is the economy slowing? You can talk about Europe, UK, US, China, wherever you want to talk about it. We all know it's slowing, but how rapidly is it slowing? Do you think that any particular regions are already in a recession? Is it going to be a mild recession, a deep recession? What's your outlook on the business cycle?
So I think the challenge, if you model recessions just like a standard quadrant business cycle approach, it doesn't really fit with the data. And that most of the time, the economy operates like a smooth engine. Things speed up and slow down. But the recessions you're truly worried about, those kind of 1-0 events, are what we would describe as cascade recessions, right? I.e., the slowdown activity becomes broad-based across all sectors. And so once that kicks in, you get a lot of positive feedback loops, and it's not very easy for policymakers to kind of kick the economy out of it, right? So to do that, the way we model is we look for simultaneous hard and soft data stress, right? So the classic example would be, say, high yield spreads widen initially. That's a soft data stress, right? That's just the market getting worried. But if high yield spreads widen for long enough and the company's got to refinance, suddenly they're running out of cash, they start laying off workers start having less cash in the economy, then suddenly earnings, revenue goes down, and then their credit spreads widen even more. So I think that's the true kind of concern. So when we model it like that, we have some Bayesian updating models that can be a bit more responsive. So you actually end up, it's basically like 0, probability, and then literally in 2 months it'll be a 1. So that's kind of what it'll look like. So on these models, Europe's already been in a recession since April and May of this year. China's been in recession since November last year already, and still remains in recession. So China's been in recession for 9 months. And the US risk, as of this month, has really shot up. Now, obviously, I know we're technically already in a technical recession, right? We had the 2 consecutive negative GDP quarters, but obviously we know the GDP deflators has a huge part to play, because obviously if inflation bias higher, the real number's lower, and there's going to be some revisions linked to it. So it's still probably touch and go, because what happens if the nominal numbers are really good and the businesses keep going? They might not necessarily go bankrupt on the back of this, right? So that's the consumer is still kind of okay in that they're spending, but in real terms is low. So I think it's on the US, I would say the risk has gone from essentially 0 2 months ago to now it's like 50 on the model. So it's been a pretty dramatic shift, and it's because a lot of the hard data stresses are picking up. So the soft data, i.e. financial market sentiment, that's been recessionary in the US for most of this year already. But the challenge has been that the hard data has been okay, but now the hard data is starting to kind of deteriorate fairly persistently, right? US initial claims are pretty much just trending higher, right? Like a lot of these things are starting to kick in that does materially increase the risk. that in a month or two, when the MBR eventually dated, it'll probably date the recession to sometime now, essentially, right? That's probably been the biggest shift in a lot of our models in the past 2 months.
So you think there's a 50% chance that the U.S. does not go into recession?
As of right now, based on today, where it's a 50-50 whether we go in next month. So that's how the model works. So it's a rolling projection of are we in recession this month? So the way we built the model was because the MBR dates recessions way after the fact. You're never going to know in real time, right? So we everything's fitted to the real time MBR definition over history. So this is what worked for us, our sample in kind of 2009, and it was 1 month late in 2020. But I'll forgive the model that given it was a kind of government lockdown recession. So as of right now, it's saying this month was 50-50, but not quite. But probably next month it'll probably flip, and then the MBR will probably define next month as actually a recession. It's probably how it would.
So if you add those probabilities up, the odds that the U.S. goes into recession over the next 6 months is substantially higher than 50%.
If you consider Europe and China already in recession, and you would need the Fed you would need policy easing big time in the U.S. to probably sustain, right? And we're not getting that. So yeah, it's probably it looks pretty likely.
Yeah. Tian, it's my understanding that, if you do a back test, and I've seen people do this, I've looked into a little myself, but like if you do a back test of, let's say, a U.S. recession, 6 months or 9 months into a recession, kind of a good time. It's pretty close to the bottom in risk assets. Like it's kind of a good time to buy. So if you say that the Chinese a recession started in November, we're, 10, 11 months into a Chinese recession. Is it time to buy Chinese stocks?
Well, so we've done a lot of. Well, I would frame it like this. I think a lot of Chinese assets are so cheap. It's like a time to buy, but it's a time to buy in the sense this is how you trade emerging markets, right? You buy when the news is so bad, and when it's slightly less bad, you need to flip it out. I would say if you're asking, is this the time to buy where you want to be balls long for the next 2 years? A lot of the signposts that you need are still not in place. Like we just put out a big report around this where we've gone back and studied every major market bottom in history to look for what are the patterns and checklists you need to know it's truly the bottom. So that even if it's 15, 20% off the lows, you can close your eyes, full long, go to the beach, right? And so what you observe is Fed policy easing has been seen at every major market bottom. Okay, not just pricing slowdown, straight up easing, and usually they be easing for a few months.
Yes.
Curve steepening. So you need a big bond market rally on a recession scare initially, and then bonds start to sell off because the market believes that easing is gaining traction. So you get big curve steepening. Right. So again,
the front end is very low because the Fed is easing.
Yeah, which again you don't have today. So you don't have the surge in bond rally. You don't have the curve steepening. You don't have the Fed easing. Again, money growth, especially M1. M1 is usually rising for a bit before the bottom. So again, we don't have that M1 slowing. Things like consumer expectations to their assessment of present conditions. That ratio usually flips before the market bottom, right? And again, we don't have that today. So all you have today is basically the market side. So, clearly, sentiment is very bad. Stock price is down a lot. Breadth is very bad. Positioning is very low. So on those fronts, you do typically see at the bottom. But from a macro overlay point of view, the key kind of macro signposts are not there. So that's why I frame it as, it's certainly I wouldn't want to take a big risk on it either way. And in fact, given how much we squeezed, right now I'm looking for a lot more downside kind of trade structures, right? Obviously, we talked about doing some of these put spread collars to year end. That's just extremely attractive right now.
Right. So that's the US. But what about China, where, some of these internet stocks are down 70, 80, in some cases 80% from their highs. And where are they headed?
So that's why I frame it as a time to buy, right? I think, again, it depends on your time horizon. If you can hold something for 3 to 5 years, and the valuations are probably compelling enough that you can sift through and find something. I mean, I've personally been more looking in the mid to small cap range because it is a bit unknown, the kind of delisting handicap risk overhang, all these things I'm not sure about. Whereas I feel like in small mid cap space is a little bit better. But the concern with China is, again, I think I would characterize it as you essentially have two fundamentally opposed forces that's not going to resolve itself this year, right? Zero COVID plus trying to stimulate the economy. And if the policymakers themselves don't know and they swing between the two, the headline risk is still very, very high. And so, even a lot of our trading models in China has not really worked well this year, just because even if something shifts, like the headline risk is so big, it just kind of knocks everything back. So I think that the chop is very difficult. So again, I will characterize China as like an environment where your gamma is probably going to realize very well, because you're just going to keep getting news around they want to support the economy, easing the crackdowns over, so things rally, and then they just come out with zero COVID again, or some kind of COVID outbreak, and then they have to shut it down. I was just saying we're going to be stuck in this until it resolves itself. But if you look at the pace of vaccinations in China, it's incredibly slow, right? Old people don't want to get the vaccine. So at the current pace, it's going to take till like middle of 2023 to get even 80% boosted. And we already know that the China's domestic vaccine isn't very good, right? We know like it's not that effective against the kind of newer variants. It's not quite like an mRNA vaccine. So I think that it's just stuck between the two. So it's still probably a trading environment, I would say. And our China LEI hasn't turned up at all. In fact, it's still making new lows, which is obviously, again, very worrying, because going back to kind of what I said, in theory, things can't really fall much more. You just think it can't fall more. And then every time we refresh the model, it's somehow lower. And we're like, what's driving it lower this month? And now it turns out, there's a global trade slowdown. Now there's a global manufacturing slowdown. The China domestic data is just like an L shape. It's trying to get up off the floor, but it can't. So I'm kind of just trying to, again, just let it play out, wait for it to play out. So in my head, the roadmap is very much, we remain risk off, remain bearish. We have some trading models to help us kind of get short again. But what are the key signposts to get bullish again? Inflation, US inflation has to peak. US inflation peak will confirm that the market Fed pricing is correct. And then China does easing. If those things are met, even if markets are 30% off the lows, right, I would feel confident being long equities again for the next 2 years, because the next whole cycle will come again. And as of right now, we're just nowhere near. So then it's kind of a choppy trading kind of environment. There's going to be a lot of uncertainty, a lot of headline risks. So yeah, it's not the easiest time, but certainly if you got to allocate somewhere, it's not bad, right? I mean, there's a lot of companies trading like 2-3 times PE, and they got legit businesses. So I'm like, how wrong can it go?
What about Europe? A lot, because of the war, a lot of, inflation is so high. The ECB is not really hiking. I mean, they did hike, but they're but behind the curve. How do you think about allocating to European stocks?
Yeah, again, I think on our models is being recession. Europe LEIs are making new lows. One of the best predictors of Europe, at least historically, is being a lot of Swedish data, because Sweden is kind of a small open economy that's exposed to Europe. And so it actually gives you a small lead. So you can just kind of track what's going on in Sweden. The Swedish data is also pretty poor. So it kind of suggests the European PMIs or these things are going to go below 50 soon as well. So it's probably not the easiest environment. As you say, it's ultimately the epicenter where the tail risks are a lot larger, right? Like, there's a reason when you compare like for like, nat gas prices are 10 times higher in Europe and Asia versus US, right? Ultimately, again, if you had to pick somewhere where you feel like they have the most structural resiliency to the various tail risks we talked about in terms of food, energy, all these things, the US is still going to be the best place, because they are food exporters and energy exporters. Europe's is the opposite, right? And so you see in the prices. And so I think that, they probably deserve to have a big discount, just because you got these tail risks are pretty real. And the ECB is obviously somewhat hamstrung in what they can do. Yeah, again, I'm just defaulting back to like the usual playbook, right? Which is you want the liquidity cycle to turn. You want to see some signs that policy easing is going to come through. And you want to see some pickup in consumer expectations relative to present conditions. And you want to see, and if those things aren't quite there, it does. It's probably not quite the time yet.
Tian, the dollar has appreciated markedly against other currencies, not just emerging market currencies, but the euro and the Japanese yen, which comprise the U.S. dollar index, the DXY. Caught a lot of investors off guard this year. Not you were bullish of the dollar, but you've been neutral actually for a while now. Why have you been neutral? I want to first hear about that. A lot of people saying that it's due to this huge risk off thing, blah, 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 blah. I'm more of just like, open up your macro 101 textbook. Like, the Fed is hiking, the Bank of Japan is not. It really is that simple. So yeah, why do you think as the dollar's been rising? And number two, how does a strong dollar impact your measuring of liquidity?
It was a lot easier of a trade back in in July 2021, right? When it's just super contrarian, you have all the kind of factors in place. So our framework for analyzing the dollar is basically the dollar smile framework that Stephen Jen originally developed when he was at Morgan Stanley. I think our sample is the best framework I found. I've tried all sorts of models and stuff, but it's so simple, it just works.
So the dollar smile refers to like this type of thing where on this side, if there's a recession, a global depression, something really bad, the dollar does really well. But then also if the US, if growth is super strong, it does really well. It's in the middle that the dollar does not do well.
So it's basically back in July last year, you're like, US leading indicators are great. Leading indicators for everyone else is bad. US economy is going to outperform. It's super contrarian because everybody's short the dollar. It's going to be a great trade. So we basically rode that all the way up to kind of March this year. And so coming into it, the base case was that usually the dollar peaks on the first Fed hike, right? That's basically been the historical pattern throughout. So we had this bias coming in that after we get the first Fed hike, usually like the market does a good job of discounting the initial Fed hiking cycles, so it gets pricing the dollar peaks. Now,
Tian, sorry, going back to when? Going back 10 years, 15 years, or 50 years?
For as long as there's data. So we've gone back at every cycle and actually, to be fair, the dollar didn't float, right? Obviously, the dollar only floated recently. So certainly for the last few, in that it might not necessarily peak exactly on the first hike, but typically on the first hike afterwards, it does tend to come off a bit. Just because generally the market it's because, especially in the transparent era of the Fed, usually central banks do a very good job of forecasting and forward guidance, right? Guiding people to work.
There we go. I knew it was coming. Yeah. I knew it was coming.
So normally they're very good at guiding the market into the hike, so that on the hike, usually expectations are really well calibrated. So this is usually what should happen. Now, obviously, this year coming into it, you got the initial Fed hike where they left a lot more uncertainty about the response function and the path of inflation. And then obviously the Russia-Ukraine war was an ongoing factor, so the euro kept selling off, and obviously 60% of the XY, and then China did a lockdown. Right, so I think those factors probably drove like the final kind of dollar surge that we didn't kind of bargain for. But in terms of the underlying dynamics, it kind of does make sense in that the dollar smile still work, right? The US is still the best house in a bad neighborhood. That still remains the case today. So again, if you're asking me like strategically, like gun to the head, it's still going to be a long dollar. But it's very hard to ignore a lot of kind of like positioning and like sentiment or like graph divergence data.
Tian, if I had to ask you, Tian, over the past 7 months, what is the reason, and you can only give one reason, why the dollar has gone up? Is it A, interest rate differentials, i.e. Fed hiking, no one else is hiking, or B, risk off? You have to pick one. Or is it C, something else?
I would say probably risk off, catalyzed by genuine shock of Russia-Ukraine war and China lockdowns. I think without those, you probably wouldn't have got as extreme a move. So they probably somewhat exaggerated the shape.
Yeah. So we all know what the forward like Fed is going to hike. The terminal rate priced in by the market. This is not necessarily what's going to happen. Is going to be December of January, like I don't know, 3.4%, somewhere around there, and then start cutting. What do the forward rate curves of Europe and Japan look like? Because if they stay at zero, if Europe stays at zero, and over the next 6 months, the US gets to 3.4%, I can imagine the dollar going higher.
But yeah, to your point, the shapes are really different, right? Because I think basically Bank of Canada, Bank of England, and the US, they've all been trading sympathy with each other in terms of this theme of just front-loading hikes, pulling stuff forward, and then having to cut next year. But obviously Europe's being out on its own in terms of just less front-loaded hikes. There's more hikes coming next year. So obviously from a purely 2023 point of view, you've got this extremely large divergence right now between the market saying the Fed will go into reverse, yet somehow Europe might not be. So I do think that's a pretty interesting money market divergence trade that probably can't. So you can probably express it outright. I think on the FX front, again, we've tried testing it, and for sure, rate differentials are very correlated to the move, but most of the time we found it's somewhat coincident. It's the forward projection has not been particularly good with rate differentials. So for example, if you just literally plot real rate differentials, right, for G7 against US, overlay the DXY, overlay trade-weighted dollar, they move together. So it's coincident. It's not necessarily leading. I think what we found that has generally been leading is the dollar smile idea. So you really care about the times where the US is going to really outperform or really underperform. So I think that's still probably going to be the main driver where the US still probably will outperform the rest of the world by quite a lot, especially any tail risk scenario around food or energy, nat gas price, any of these things. So yeah, that's probably my core underlying dollar framework.
Well, Tian, it's been great having you on Forward Guidance. Could you summarize your views a little bit? What do you think about commodities? What do you think about stocks? And what do you think about bonds?
So like I said, I think the key thing is that we have in mind different roadmaps for how things are going to play out. The future is inherently uncertain, so I don't think you want to necessarily just go by one view. An interesting roadmap we have in mind for how this is supposed to play out is 1984, which was the last time you had a bond and equity crash against a backdrop of rising inflation, Fed front-loading hikes. The Volcker Fed at the time did like a 100-bip hike. And also you had a big step down in GDP growth and liquidity, right? So it's a pretty good analogy for today. And the key takeaway from that is inflation, the market is bad at front-running inflation. Inflation had to have peaked. And once it peaked and fell for 2 months, then the entire yield curve came off. So yields genuinely peaked across the board. And then in August 84, you had kind of one of the largest 3-day rally in equities up to that point. So you had then, once those pieces were in place, you had like a really big comeback in equities, and it was kind of the start of the next kind of bull market, right? Because it enabled kind of Fed policy pricing. So that in my mind is like a core roadmap for how this year is going to play out. So depending on how quickly we see the peak in CPI, that will naturally pull forward or back when to start turning more risk on. But because we're not there yet right now, I would say it's a risk-off environment, long bonds, short equities via put-spread collars, because the vol surf is very attractive to do that. But that's what I'm looking for. So I'm still most focused on kind of the CPI releases, the commentary around CPI, because that's kind of the critical initial milestone to hit. And then once we hit, we see how the curve behaves. If the curve does then say start bull steepening, whatever, that kind of thing, right? After we see the peak CPI, that'll be a very good sign. Then you have even more confidence that roadmap plays out, and you can kind of get, scale into more aggressive kind of risk on trades. So that, that's probably the best way for me to summarize it right now, rather than just be straight, have a view. I think we are in a pretty uncertain environment. So I think that the contingent plan is probably more important right now than having one view and sticking with it to the end of the year.
Okay, Tian, I'm a little bit surprised to actually hear you cite 1984 as sort of your roadmap for this year, because 1984 was the beginning of a 40-year bull market in bonds and equities, and the two Volcker recessions that that tamed inflation were already in the rearview mirror by then. And I'm looking at sort of the CPI from 1980 to 1988, and so it fell dramatically from 1980 till June of 1983. But then, as you say, it had a pickup that peaked in like April of 1984, and then it fell from but then it was at 4.5%, and it fell to 3.35%. We're at 9.1%, and don't you forecast that inflation will sort of be at 9% or
the shape's going to
high
lower,
eights
right?
by the end of the year?
So again, how do we find an analogy? We take all the data inputs, we do a dynamic time warp to give it a bit more scope for the shape to expand or contract. So what we're looking for is not necessarily the absolute levels, but that the shapes across all these behaviors match. So absolutely, the levels aren't the same. Equity starting valuations were a lot lower. So I don't think this is like a 10-year, the next 10 years, but this is obviously, I think, pretty good for the next kind of 3 to 6 months, because
is shape another way of does that relate to rate of change?
So everything is rate of change. So the rate of change of how things behave this year is more similar to the rate of change of how the initial part of that year played out. For sure, in absolute terms, right, valuations are way lower back then than equities are today. As you say, right, Volcker already broke the back of inflation in the late 70s. So absolute levels wise, it's definitely not exactly comparable. But I think in terms of guidance of how investor sentiment reacts to an environment like today, where everyone sat around looking at each other going, man, bonds and equities crash, my volatility hedge is not paid out, everybody's sat on losses. Inflation, when's this thing going to be over? Oh man, you're similar, right? You go back and read the headlines. There's Volcker saying we're going to keep hiking, right? You have newspaper articles talking about, man, we need like the Fed to like intervene, right? Like it's very similar kind of dynamic. So that's why I'm like, that gives me a good sense of a cyclical roadmap. For sure, structurally, in terms of coming out of this crisis, what's going to perform, it probably is still going to be linked to the capital scarce sectors, right? We mentioned commodities, there's some stuff in LATAM we like, but this is purely I think if you're asking me to the end of the year, I think that's a roadmap I've got in the back of my mind.
Okay. Yeah. So there are a lot of really smart people, Tian, who really they focus on the rate of change. And I think that the rate of change has served investors well over the past 10 years. In other words, don't think about, growth's at 3%. That sounds low, but it's coming off of 1%. So it's actually, that's reflation. You want to buy assets. But I think, I don't know. Tian, I think there's a difference between going from 5.5 to 4%, from going from 9.1% to 7.5%. I think 7.5% is still really high. And a 30-year at 3% doesn't sound that cheap to me when inflation is at 7.5%. So do you think that looking at the absolute levels of, inflation is here, bond yields are here, do you think that is helpful, or it actually can be confusing?
Once we control for this idea of liquidity, right? Because in our framework, liquidity is merely one piece of the liquidity picture. Inflation is something that massively detracts from liquidity. But obviously, if we capture already, then the absolute level of it doesn't matter, because it's about where's M1 growth at the same time and where's economic growth at the same time. Like, are those three, the relation between the three are kind of, in our models, at least we found over time, is a bit more important. Equally for the 10-year, once we control for those factors, the absolute level doesn't seem to consistently have predictive power. The curve still does, but the curve, as I say, is more correlated to policy impulse. So, we'll have to see, right? I mean, one thing I am paying attention to talking about levels is the term premium, because again, for us to, in your scenario, what you're essentially saying is at some point the bond vigilantes are back. People get really concerned that the Fed is not on top of things, and nobody's going to, knowingly lock in a negative real rate. So the entire market will go on strike, a buying strike. So then everything re-rates higher. Now, where you should see that first is in the term premium behavior. So the problem today is like the term premium remains very negative still, right? And then the value.
Tian, can you just explain that? I've had probably the term premium explained to me. I've looked it up probably 30 or 40 times, but it still confuses me. So the term premium is like the difference between what the actual treasury yield is and the implied rate is if you just roll the overnight rate every time, right?
Yeah, kind of. Yeah. So I mean, I think about it as like, so again, in a free market, that's not like that doesn't have government intervention. In theory, you should demand a higher risk premium to hold a longer duration asset, right? Because more bad things can happen. If I lend to you for 1 year and I lend to you for 30 years, in theory, I should care more that if I lend to you for 30 years, I should demand some extra risk premium above and beyond what I think the actual rate is going to be, because there's some higher risk something goes wrong, right? So in the pre-Fed QE days, term premium was pretty much usually positive, because obviously, in theory, you should get paid more to take on longer term risk. And essentially what's been happening since like 2016 is term premium has been persistently negative, because we live in like a world of financial repression where obviously the entire curve is basically pinned by policy. And also because there's regulation stuff forcing people to hold bonds, right? So we basically live in an environment where term premium has been negative for a while. And in fact, it went way negative during the COVID recession. So this thing in and of itself is no longer doing what it's supposed to be doing, which is reflecting a risk premium. It's literally now just a reflection of how much control the Fed has, in my mind, over the bond market. So when this starts going a little bit, if this starts going, then in my mind, it's probably a sign that there's a more of a concern around the treasury market, about the behavior. And then maybe that'll be one of the first signs to then, that maybe your scenario is going to, the risk of that goes up, right? Where people lose faith in it. But like I said, based on almost everything in how money markets and fixed income markets trade, I would describe it as the bond market has given the Fed full credibility, right? I would take it to that extent. There's no behavior within the curve or the money markets that's saying that the market's going on strike. right, against the Fed. So you would need something else to happen, right? This would have to be, say, consumer expectations truly go nuts. People start potentially rioting, complaining, unionization, these things take over. Then obviously the tail risk changes. It's not going to come from the market. It's probably going to come from outside. It's probably how we're
right.
Yeah.
That's how I used to explain it. Was the term premium is like a 10-year bond, it's riskier than a 2-year note, so you should get a higher yield. But it's not just the spread, right? It's not the spread between the 10 and the 2. It's the spread between the 10-year treasury note and sort of and what? How do you calculate it? And go get in the weeds. I can handle it.
For lack of a better word, it's technically like you have I think it's what's called a risk neutral estimate of what the rate is. You can compound it forward. Now there's some issues around how you estimate the risk neutral rate that you're supposed to grow forwards at, right? So
is that LIBOR, SOFR?
The Fed has essentially what's called the ACM model. So the most commonly followed is whatever. I can't remember exactly how they do it, but essentially you have some estimate of what risk neutral short-term rate is, and then you come up with a risk neutral, and then you kind of effectively compound it forward, right? So it is technically a residual. Now in practice, obviously, it's basically pretty correlated to a 3-month 10-year yield curve in terms of the shape. But what I find interesting about it is essentially whether it's positive or negative, right? Because I find it just fascinating, the fact that you can have this residual something that's worked for many years beforehand has just been broken by central banks. And so if central banks are stepping back, is this thing going to start having information again? Because actually, going back to what I said earlier, if you plot the market cap of bonds versus equities available to the private sector, the change in that is really correlated to the change in term premium. So actually, it's almost like you're reflecting this underlying dynamic of the Fed is forcing people to buy bonds. So the more the Fed forces people to buy bonds, the more negative term premium goes, and vice versa. Like that could be one way. I'll send you the chart. Right. So that's why I find it very interesting that I'm using this as almost like a potential warning signal that if this thing really jumps, then maybe there's a change in the dynamics of the Fed with the bond market. Yeah. So that's kind of more probably the context as one thing that I consider a pretty good tail risk warning sign for the scenarios you talk about where yields have to go higher, right? Because again, the classic thing coming into this year was I had so much pushback when I was like, the curve's supposed to flatten this year, because into every hiking cycle it just flattens. And then the precise argument is this: well, inflation will be so high, if the Fed doesn't go fast enough for the front end, shouldn't people completely lose faith? And then you should get curve steepening. And that will just be driven by term premium, right? Because people don't want to hold the bonds. But again, it just hasn't happened. So I'm not saying it won't happen, but it'll be
well, but the Fed has hiked really quickly though, and they've used forward guidance to hike, the 3-month, 1-year, 2-year, 5-year rate. Yeah.
So but obviously in absolute terms, we're still miles off, right? The entire, if you compare the headline CPI, obviously we're miles off. But obviously, if you compare the break evens or where inflation swap forwards are, obviously we're in the range.
Yeah. Well, Tian, sort of the commodity supercycle thesis that you enumerated in the summer of 2020. That has played out incredibly right. I mean, the amount by which that thesis is right probably surprises even you. And that is a large part of why we have such high inflation. So given that, I want to ask you, in December of 2023, the year-over-year CPI rate, headline, not core, headline, what is your 95% confidence range on the low side to here? What is Tian Yang's Mr. Commodity Supercycle's 95% confidence interval for the December year-over-year, December 2023 year-over-year headline CPI?
So my crystal ball is a little murky for these precise date things. Usually I get a lot more confidence on a 6 to 12 months where there's a lot more variables that allows us to predict. Because obviously here you're predicting from a level you don't know to something else.
All right, August or July 2023. July 2023.
The problem is, right, you got 4 bits. Assuming food and energy is fine, then I would say you're probably in the 4% plus or minus, right? But the food and energy is such a wild card because at the moment you got a pretty good sense on what goods and services and housing is going to be. So if you only had those pieces, I think you have a lot more confidence on where these things are going to come off to. But the food and energy is kind of all over the place. I turn the question around. I'm like, do I think ultimately real assets going to perform well from now until that point or not? Then I'll probably just be even with a recession, I'll bet real assets perform well in that the problem hasn't gone away.
Oh, like commodities.
So I think, if you have assets that are positively exposed to inflation surprises, it's still probably net. you obviously there'll be probably some vol in recession times, but then there'll be some realization that a lot of the problems linked to inflation with once the transitory factors come back, supply chains, people realize actually there's an underlying kind of issue here still, right? Even with the transitory year on year, right? The classic example right now, fertilizer prices, right? Year on year is probably going to slow down to zero soon, but as you say, in absolute terms, it's like it's up like so much, and and then it has all the tail risk effects where, well, if it's so expensive, did people plant fertilizer in emerging markets this year? If not, then we're going to have no food. If you have no food, you can obviously get a huge amount of food inflation. So yeah, again, I think because the futures path to plan is very hard, but from what we can see right now in terms of what the market's pricing in, then clearly the market's pretty sanguine about inflation risk, right? Especially if you look at the inflation swaps term structure curve, it's basically super well behaved, right? It's like here, it just comes off very smoothly. So then tail risk should really push that to the upside if there is an issue around any of these commodity linked things, right? Or if Russia's forced to cap a pipeline, right? Or something like that. So yeah, I would say that you're probably, in terms of what the market's discounting, you're probably better off betting on the upside, given the pricing today. That's probably a bad way to frame it. But in absolute numbers, I mean, the margin of error is so wide, right? Nobody's model has been banned on even this year. Like, it's just all over the place.
Last question, going back to the commodity super cycle, energy has been the stuff that's been going up the most. What is you said you like shorter term forecast. What is your 3 to 6 month outlook on oil and natural gas?
So I think basically we're just going to be bullish until like a recession really hits. But like I said, the model's saying it might start to hit next month. So again, I don't want to keep giving the contingent answer, but the answer is essentially all the structural pieces that are in place to make us bullish are still there. So we're going to be structurally bullish. The cyclical picture is going the other way. So you kind of need to be sensitive to the cyclical picture. And because the recession risks are picking up, it probably isn't the time to just keep all your exposure, right? So for example, I would just characterize we've been max long energy despite all the previous downturns and basically into this year. And right now I would be just saying I'll be slightly long to perhaps even just having a flat structure, or if I'm long, I'd be overlaying put spread collars on top, right? Or even within like XLE or these kind of things. Like I'd be thinking much harder about I'm happier to sell the upside now, take advantage of where vols are to try to basically we live in an environment where longer dated vols are quite expensive. So I want structures that allow me to monetize vol and then giving my portfolio an overlay, right? But that essentially just means I have low directional conviction for next 3 to 6 months. I'm trying to use vols to hedge, right? And I'm waiting for the tactical cyclical structurals to align again before I really want to make that big bet.
Yeah. And what's your outlook on volatility, implied volatility? I feel like a hallmark of this year has been very high realized single stock volatility, but very low implied volatility on the S&P 500. Do you think that will change or continue to be a hallmark?
So, well, the reason is obviously because correlations of realized low, right? And obviously dispersion, these kind of things. Just because you had energy outperforming, you broke a lot of the previous patterns of how sectors behave. So, that's probably going to persist until we hit the genuine big recession kind of scare, right? Because I think that it does make sense in terms of the underlying rotation, the rotation towards kind of real assets as to kind of, or kind of more inflation exposed assets has to fully play out. But it's a funny one because, again, if you look at market history, usually you get some kind of big vol spike or some kind of big, VIX should really like have a panic moment to mark a bottom. And, as you say, precisely this year, especially if you look at daily, so we build advanced decline lines for whether the VIX is outperforming every day versus S&P, and it's just persistently underperforming the whole way down. And, I've seen so many different explanations from dispersion to the fact that, everybody's de-risked, there's less put demand, or, there was all this like JP Morgan put spread collar or something that was capping it because, there's so many explanations. I'm like, maybe it's just but it would be very strange to have a major bottom where you don't get a vol spike. That's all. So I'm just like, okay, my base case is probably do need to see some kind of major vol spike at some point. So on net, even though there's a lot of small explanations, I'm like, if, for me to hedge that real big tail risk, if I do think it's a recession, then it probably does make sense to get some kind of upside to it. Now, so, things I'm looking at is when can we do like a call spread or something on the VIX, even though it doesn't pay out the best. Usually, I think it's like a nice structure to potentially overlay. But yeah, it's really tricky.
Yeah.
It's just weird, right? Like it's like nothing's worked if you needed to hedge. You had to just be long cash. So, yeah.
Or short. Short Carvana, that would be a good hedge. Short Netflix. Oh yeah, so it's talking about Carvana and Netflix. what sort of another hallmark of this year has been the huge underperformance is of, let's call them speculative growth stocks. I guess the sort of face of that is ARK, but Zoom, your Coinbase, your electric vehicle stock that's has never made a car, that's down. Just really had a very tough year. Do you expect those stocks to continue to underperform the market for the rest of the year?
I think there's a lot of talk about, because obviously they're very high duration stocks, so as bond yields stabilize, they should start to do better. But I don't really buy that as much because excess liquidity is still extremely bad. And excess liquidity is ultimately going to be the driver for a lot of these high duration stocks, because you're in the period where even if all the bullish analysts are fundamentally right on where they think the fundamentals are, there will be a full re-rating, right? And the re-rating is not just purely a function where 10-year yields are, it's also a function where excess liquidity is. And if excess liquidity is so poor, you can't really sustain very high valuations anywhere. So I do think the fact that the discounting's come off, it's not going to go much higher. And also, it's people are finally realizing like share-based compensation is a real cost, right? Like it's really going to eat into gross margins for all of these companies. And it's like the gross profit margins are really a lot lower than they think. So I think those things together, in a still extremely bad excess liquidity environment, suggest you got to be pretty brave to bet that the short squeeze lasts all this time, and then people are going to take it off your hands, right? Like, I think those are things of, again, like when the tide goes out, people should just realize how much share-based compensation, matters for these valuations, right? They're going to start firing work. You're going to start seeing this. So, yeah, they probably need to fall a lot more before I get excited, I would say. I've been looking and I'm like,
No, thanks. Nice. Well, Tian, it's been wonderful having you on Forward Guidance. People should definitely follow your work. Your company, Variant Perceptions, Twitter handle is, I believe, VRNT Perception. Tian, you have a very interesting quote that, what is it about a man with a machine just beats a machine? Explain what that means. And folks have noticed you're very data driven.
So I think that the quote is originally, from Gary Kasparov, which is essentially man plus machine beats machine. So I think, the niche we're trying to occupy is, I think we got a lot of very good quant data science chops and like a pretty good tech stack, but we don't think of ourselves as quants or data scientists. I think we're really fans of economic history and actually, learning from all the other really smart investors, thinking about what's their framework. So I think we're trying to sit in the kind of Venn diagram, the niche between the two, where can we take a lot of these great insights? For example, we talk about LPPL, DDS.net, right? All these great ideas. Can we put our data science chops on top to make something that can repeatably work going forward as a sample that guide us to themes like the commodity supercycle, right? Which again, derived from a capital cycle model. It wasn't just we sat down, suddenly there was a light bulb moment kind of thing. So so I think this man plus machine beats machine is something that's I hold very close to me in terms of how I think about the market, and it gives me, and oftentimes the machine proves the man's intuition isn't right, and it's almost always better off to go with the machine in many ways. Yeah.
What is the one thing that a lot of investors believe that the data just says is not true at all?
That's such a good question. I think most investors get too sucked into like the narrative and their own ideas, and most of the time liquidity is king above all else to an unbelievable extent. I think we all, even for ourselves, we have these models that have been working for so long, and the mistake is always, okay, liquidity is bad, but this thing is so cheap, right? This trade makes so much sense. There's all these catalysts. Clearly this trade works, and most of the time liquidity is king. And like when liquidity is bad, like everything falls. When the liquidity is good, the rising tide lifts all boats. And even though that sounds it sounds obvious, but I think it's just, I think everyone just underestimates how powerful it is and how long a tail that casts. I think that's yeah.
Well, Tian, thanks so much. Really appreciate you being generous with your time and insights.
No, thank you, Jack. I say I'm a huge fan of the podcast. I think you're doing really amazing work. I'm definitely, I might not listen to it all on the first day, but I make an effort to listen to all the recordings. So yeah, thanks for having me on.
Oh, well, thank you. I appreciate that. There is something that you need to be doing right now, and that is reading the Blockworks daily newsletter. For top market insights and the latest in crypto news, you have to subscribe to the Blockworks daily newsletter, and you can do so by clicking on the link in the description to this video or by visiting blockworks.co/newsletter.